I suppose, we can just have a look at the language of the Fed. Of course, the verbiage has changed quite dramatically in the last couple of months. Give us a sense of not just this hawkish tilt, but the fundamentals here. We've got we've got more supply because the Fed's not buying as many bonds, and clearly that's going to send prices down, and that's going to push up yields. Is it something that market participants didn't take account of?
Yeah, I mean, we're in a really interesting transition period at the moment when it comes to the most likely path for the Federal Reserve. And so I think there's quite an adjustment that's happening across global markets, including here in Asia. So, I mean, we're expecting that the QE program will wind down in March, and then we'll start to see a rate hike probably in April or May. And so, as you correctly point out, I mean, that's quite a different profile than what was expected and really foreshadowed by the Fed just a few months ago. I mean, the Fed was really expecting that we wouldn't, put a rate hike into the picture until full employment was achieved in the US, and that's not likely to happen until 2023. So this more aggressive, more hawkish profile really means that the journey and towards full employment in the US will be somewhat delayed. And so markets are really adjusting to that at the moment.
Well, ultimately, also, we are looking at the employment picture. That's one of their remits, naturally. And Katrina, how much significance should we put on Friday's jobs report, and what will it tell us?
So we're expecting that Friday's jobs report will be upbeat. And so, that's important in itself because it does really go to show the strength of the US labor market. But of course, Friday's job report doesn't really take into account Omicron. And so we do know that Omicron is having a significant but temporary impact on the US economy right now. And so we are expecting that January's figures will start to show more weakness in the labor market, but not just the labor market. We're already seeing that consumers are reacting negatively to Omicron. So we've seen that credit card spending has eased a little bit. Schools have been shut down in some areas. So there is that move to online learning again, which is causing disruption. And so those kind of factors will also, be worth watching because, of course, Friday's jobs report is backward looking and conditions have changed quite significantly since then.
Katrina, what do you make of the fundamentals of the U.S. economy, and what is the bigger risk to it? Is it a Fed that raises rates aggressively, or a Fed that stalls on rate rises because of expectations of a slowing economy?
Yeah, that's a good point. And I mean, if we're looking, just at immediate near-term risks, I would say that the pandemic is still really the #1 threat to the US economy, because we do know the Omicron variant has increased downside risks and uncertainty about the near term. But I mean, longer term and looking into 2023, a more aggressive Fed. So if they do pull the trigger on rate hikes too early and too aggressively, then that will really start to hurt the US economy, particularly in 2023 when the impact of the rate hikes today and the next couple of months start to really impact. And there's of course that delayed impact with the transmission mechanism. So 2023 is where we will start to really see the impact if the Fed is indeed acting too aggressively and early when it comes to policy normalization.
I mean, we're seeing new restrictions in Hong Kong, Xi'an under lockdown. We have Ningbo port in China, which is a key port for China and the world, facing challenges. At some point, we have surely to reassess growth projections and where inflation goes from here.
Yeah, that's a good point. And I mean, what we are really seeing across Asia Pacific is a difference in how economies are managing the virus. So we've got places like Australia that are learning to live with the virus, but then you've got places like China and Hong Kong that are really resisting. And so it's particularly problematic China potentially because they are such a key hub in the supply chain. It really does add downside risk to our expectation that supply chain stress will continually and meaningfully ease over the first half of this year.
China's looking at 5% growth for the year. Is that projection at risk, and what might that mean for the rest of the region?
So our expectation is that, China's GDP growth will hit 4.7% this year. So that's meaningfully slower than the estimated almost 8% expansion that we're looking at for last year. And so if, there are, increased and heightened downside risks that are really threatening China's economy, that they might not hit that almost 5% growth rate. The slowing property market, the climate change objectives that they have, the buildup of financial risks. And if any of those issues really, explode to some extent, then it will mean that not just Asia Pacific, but global growth will be hurt as well, just because China is such an important stimulus for global GDP growth.
Katrina, how much can we put this also down to the structural shift in the Chinese economy on the one hand, and also the zero COVID policy that they are pursuing?
I mean, it's incredibly difficult to kind of separate things because, as you say, on the one hand, there is this zero COVID policy. And so what that's doing is it's kind of meaning that their economic recovery and their ongoing economic growth this year will be a bit bumpy, particularly on the consumer side, but also, on the export side because of the potential disruptions to ports, production from factories closing, ports closing, and that kind of thing. So it is really difficult to separate and isolate those effects, and they are kind of intertwined as well.
Very quickly, Katrina, looking at all this as well, we had George Friedman from Geopolitical Futures on earlier saying that the biggest risk to the world at the moment is how China handles its economic slowdown. And he says that this economic slowdown is only just starting. Would you agree?
I mean, I would say that China's structural slowdown has been happening for quite some time, but I would say that there is elevated buildup of risks, and so the challenges facing China's economy are perhaps more pronounced than they ever have been before.